It's my great pleasure to welcome to TM Studio Ian Isaac, who is Managing Director of Lombard. Now, you've probably heard of Lombard. They're a division of NatWest RBS, but you specialise in helping businesses fund equipment. That's a real niche for you.
Yeah, very special, and it's all we've ever done. We've been doing it for almost 160 years. We started out funding rail wagons for the coal industry. So yeah, that's all we've ever done, and we specialise then in helping businesses choose the right asset, fund it in the right way, managing it over a specific life cycle, dispose of the assets if appropriate. And obviously manufacturing, the UK manufacturing base, it's huge, it's productive, and that's where we help the most. That's where we think we make the biggest difference. And I think in the main, we're here to support businesses make those decisions around what to invest in, when to invest in it, how it pays back for their own business. And obviously we're seeing them increasingly invest in digitising their production, so we're supporting them with robotics and 3D printing and additive technology. So we're learning about those assets and learning how we can help businesses acquire the right assets to improve their success rates.
It's a bit of an uphill struggle at the moment, none of which is of your making or indeed of the manufacturer's making. Uncertainty does you no favours or us.
Yeah, and it plays right into the space we operate in. So any sense of future uncertainty, businesses just pause. They just press the pause button and don't want to make the decisions to make significant investments for their businesses. That said, what we have found is businesses in the main have gone, we've got our businesses to run whether we're in or out of Europe. We've got customers to serve. We've got competitors to outmaneuver. So there are decisions we need to make, and we'll crack on and do it. So we found this year it's been interesting, but in the main, the market has felt reasonably buoyant for our products.
I'm going to ask what may appear an odd question, but I've always bought into the anecdote that says that when things go bad, those that invest in times of downturn are the ones who come out better on the other side. Does that hold true under any circumstances?
So, I think it does. I would love to have the data that proves that the businesses that use Lombard to invest in equipment, which enables them to get the equipment that they might have to wait for if they were paying out of their own resources. I'd like to have the evidence that shows those are the most successful businesses in their markets or in their segments or whatever. I haven't got the data, but my hunch is that's absolutely the case. And businesses, will take the opportunity when, right now I was with a customer in Edinburgh last week that was investing in new 3D printing technology. One of his major customers are the Formula One racing teams, and he makes parts for them, and they're already planning their new models for next year. And he's gambling now. He's making a shrewd investment now. He's getting equipment at a lower price. He's thinking that actually the Formula One teams will still invest, but he's just making that judgment. It's the right time to do it for him right now, and he's not waiting on anything. So
it's a knife edge for you, though, isn't it? Because you obviously want them, because that's your business. You want them to invest, but by the same token, you don't want to be the one, if things don't go terribly well, to turn around and say, well, you told me to do that.
Yeah. Yeah. No. So we don't advise them to do it, but we'll certainly provide them with guidance and support. But fundamentally, they'll make their own decisions. Yeah, I mean, it is tricky, and obviously we're in the risk business, like banks are in the risk business, and we recognise that in the cycle, the economic cycle right now, we're seeing certain segments of the market. You see that in the retail sector, being massively disrupted by online players, and I think what we're doing is we're probably, when we're choosing the customers that we want to work with those that are thinking much more broadly about their industry, how it's changing, how they survive and thrive in their industry against the threat of disruption. So we think we're always picking the winners in their markets, and of course sometimes things go wrong, and we'll have to work things through with those individual customers. But we are on a knife edge, but we're in the risk business, as our businesses themselves taking risks, and the better we know, the more we're embedded in their businesses and their industries, then the better decisions we can make to help those businesses succeed.
You used the D word there, disruption.
Yeah.
And of course, because the cycle of disruption seems to be accelerating.
Yeah.
And that means that a manufacturer with a big capital expenditure item that they want to, that they're looking at, they might say, well, if I invest in that now, it might be out of date in 3-4 years' time. Why don't I wait for the next cycle? Is that some of the thinking you come across?
No, I've not come across that I'm seeing more people pausing for the broader economic challenges in the UK and Europe and beyond, rather than a technology obsolescence piece. So just chatting to some customers around the table a while ago, they're mindful that when they're investing in digitalizing their production, they recognize it's a heavy upfront cost and some of the benefits might be unproven. So that what they're doing first and foremost then is collecting the right data and understanding what the measures of success would be before they go in too heavy with digitalizing a process. So I think us being here today is about us learning how we support those businesses making those right decisions. But I'm not seeing businesses put off investing in automation or robotics or anything that drives productivity improvements in their sector, because I think fundamentally, unless these businesses are reinventing themselves as they go along, they won't be in business long term anyway. So I don't see people going, let's wait, because there'll be a better technology along sooner.
One of the things that caught my eye was a new product you've got, which helps companies release the value in their intellectual property. This is one of the great unquantifiable assets we have in Britain.
Massively.
And we've got a heck of a lot of it. We never seem to factor it into our thinking.
Yeah, no, it's a really broad topic. I mean, so we group those types of intellectual property assets as knowledge-based assets, and it can be anything from proprietary software through to brands, through to R&D, and we're trying to build funding products for those types of assets, but they're assets that aren't tangible in the same way as production equipment or cars and vans and trucks will be. So we're having to modernize our thinking about the value in those intellectual property assets, and we're one of the first funders in the UK to bring out a bespoke product to help businesses to release capital, as you've described, against their intellectual property assets. So what they do, they effectively sell it to us and we lease it back to them, and they have the right to that software once they've finished paying their loan. So for high growth businesses that don't have many fixed and tangible assets to pledge as security to banks, this is a great way for them to raise funding, and it means they're not having to effectively give up equity to to someone who another way of getting an investor. And it's senior debt funding secured on that asset, and it's flexible and it works for them. So we only launched it earlier this year. Good take up, good interest. We're running sessions here today on that particular product itself. But we think that growth in knowledge-based assets, it's already overtaken in the UK the investment in physical assets. I think it's forecasted this year to be about 150 billion in knowledge-based assets. So unless the banking sector finds a way of financing that growth, then those businesses won't be able to invest fast enough.
Well, that means good news, because your sector is responding to demands from our sector.
Absolutely.
And that's really exciting. So good luck with it all.
Thank you.
I'm sure you've got lots more you're going to tell the participants here at Smart Factory Expo. But Ian Isaac, many thanks indeed for joining us.
Appreciate it. Thank you very much.
Cheers.
Thank you.